There's a question that really gets under the skin of any serious investor, a question that most financial statements, frankly, seem designed to hide rather than answer. And it's this. Is this business truly creating wealth, or is it just moving money around? To get to the real answer, we need a tool called Economic Value Added, or EVA.
But before we dive in, let's start with a paradox that sits right at the heart of valuation. How on earth can a company report hundreds of millions in profit, look great on paper, and at the very same time be making its owners poor every single day?
And look, this isn't just some textbook theory. Think about General Motors back in the mid-90s. The income statement, it showed a profit, but the market was telling a completely different story. For every single dollar that shareholders had ever invested in the company, their stake was now worth a mere 79 cents. The company was basically a capital incinerator, hiding in plain sight. How is that even possible?
To solve this profit paradox, we have to look past the numbers you see on a standard income statement. We need to ask a much, much deeper question about what profit really is.
See, the whole reason this paradox even exists is because we're usually taught to look at the wrong kind of profit. Accounting profit, that's the number we all see, and it's simple: revenue minus your explicit costs. But economic profit? Well, that tells the true story because it forces us to deal with a powerful and often invisible cost that traditional accounting just completely ignores.
And that missing piece, it's the cost of equity. The capital that investors put into a business is never free. It always comes with an opportunity cost. I mean, it's the return those investors could have earned somewhere else for a similar amount of risk. If a business isn't generating a return above that cost, then by definition, it's failing its owners. And that, right there, brings us to the core idea that solves our paradox. To understand the true performance of a business, you absolutely must account for the full cost of all the capital it uses, both debt and equity. And that is exactly what economic value added is designed to do. EVA is what's left over from profits after you subtract a charge for using all that capital. So it's not just profit, it's the residual wealth, the value created above and beyond what investors could have gotten elsewhere. A positive EVA? That's genuine value creation. A negative EVA? That's value destruction. There is no middle ground. The capital charge is the real key here. The easiest way to wrap your head around it is to think of it as rent on capital. I mean, a business would never dream of just ignoring the rent it pays for its office building, right? So why do so many of us ignore the rent owed to investors for using their capital? If your operating profits don't cover this capital rent, the business is economically failing no matter what the accounting statement says. Okay, so how do we actually put this into practice? Let's break down the EVA framework and see how it works not just as a metric, but as a powerful strategic tool. The calculation itself is actually pretty logical, almost beautiful in its simplicity. First, you figure out the company's true operating profit, cleaned up from any financing quirks. We call that NOPAT. Second, you calculate that rent, the capital charge, by multiplying the total capital invested by its weighted average cost, or WACC. The difference between those two is your EVA. Simple as that. And this is where EVA stops being just a number and becomes a powerful strategic tool. It gives managers 3 crystal clear paths to create more value. 1. Operate more efficiently to earn higher returns on the capital you already have. 2. Invest new capital, but, and this is a big but, only in projects that earn returns above your cost of capital. And 3. Optimize your mix of debt and equity to lower that cost of capital in the first place. All right, so this is where the clean theory meets the messy reality of the real world. To calculate a true economic profit, you first have to peel back all these layers of distortion that are just built into standard accounting rules. This quote just nails it. Generally accepted accounting principles, or GAAP, they're designed to be conservative. They often care more about reporting stable, predictable earnings in the short term. EVA, on the other hand, is built to reflect economic reality, even if that reality is a little less smooth. Let's take a perfect example: research and development. GAAP tells you that R&D is an expense in the year you spend it, which immediately lowers your profit. Of course, this can make managers hesitant to make those crucial long-term investments. EVA corrects this. It treats R&D like an investment in a future asset, capitalizing it and adding it back to the capital base. It completely changes the incentive to one of long-term thinking. And R&D is just the start, right? The EVA framework makes several of these critical adjustments. It brings things like operating leases, which are really just another form of debt, back onto the balance sheet. It corrects for funny accounting reserves and deferred taxes. Every single adjustment has the same goal: to paint an honest, complete picture of every dollar of capital that's tied up in the business.
Okay, so what does all this actually look like out in the wild? Let's see how this framework really separates the true wealth creators from the destroyers. Let's talk about Coca-Cola. They were one of the earliest and maybe the most famous companies to really embrace the EVF philosophy way back in the early 1980s. And they didn't just track it. They embedded this thinking deep into their culture, from the highest levels of strategic planning all the way down to employee bonuses. And the result? Absolutely staggering. By 1995, for every $1 investors had ever put into the company, Coca-Cola had created over $8.50 in market value. Now that is the power of a disciplined focus on true wealth creation. Now on the flip side, let's circle back to our original puzzle, General Motors. While it was profitable on paper, year after year it failed to earn back its cost of capital. It was this massive enterprise that was just slowly, quietly bleeding its owners dry.
I mean, the contrast couldn't be more stark, could it? For every single dollar that investors had entrusted to GM, only 79 cents was left. The company was systematically destroying capital, a grim reality that was completely hidden by its reported profit. So, all of this leads us to a final, really important reflection. An annual EVA figure tells you how a company performed last year, but a company's total value today is really a reflection of what the market believes it will do in all the years yet to come. And believe it or not, there's a direct mathematical connection here. It's called market value added, or MVA. MVA is simply the market's expectation of all future EVAs, all discounted back to today's value. So if you want to maximize the long-term value of your company, you have to maximize EVA year after year. They are two sides of the very same coin. So I want to leave you with this question. It's the one that separates good companies from great ones and good investors from the truly discerning. Are you looking at a business that is simply reporting a profit, or are you looking at one that is fundamentally, rigorously, and sustainably creating wealth? The difference, as we've seen, is everything.